This is Matthew Cratter from Treasury University, and today I want to talk about the money printers turning off and stocks crashing. We've really had tailwinds for the last couple years since the beginning of the pandemic, with the Fed's money printing propping up asset prices, crypto prices, stock prices, real estate prices, etc. And now what we're seeing is a sharp reversal of that. The Fed has just ended their quantitative easing program. In other words, printing money and buying assets and adding it to the Fed balance sheet. This was the biggest case of quantitative easing in history. We can see that even during the great financial crisis in 2008 to 2010, the Fed only bought about $300 billion worth of treasuries, and then they bought a lot of mortgage-backed securities, which are basically bonds that package up your house mortgage. They did this intermittently in the early 2010s, and then it began to really slow down, and we went for a period where they weren't doing that much, and they were actually shrinking their balance sheet. And then with the start of the pandemic, we had this really 2-year period where the Fed bought almost $3 trillion worth of treasuries and almost $3 trillion worth of mortgage-backed securities, and that has now come to an end. This is a historic moment. On March 9th of last week, in 2022, we saw the last purchases of treasuries, and they're about to wrap up mortgage-backed securities as well. On March 9th, we saw they bought $4 billion worth of treasuries. This is from the New York Fed website. So they are done doing this, at least for now. So the real question is, if the Fed just stopped buying treasuries, who is going to step in now? Who can hold trillions of dollars worth of government bonds or treasuries? Basel III leverage rules limit how many U.S. treasuries banks can hold domestically. They're trying to limit how much a domestic banking system can monetize deficit spending. So these sort of international guidelines and rules for the banks that limits how many treasuries banks can hold. And then we have the major buyers of U.S. treasuries have been sovereigns. They've been countries and central banks like China and Japan, for example. Smart countries now, especially countries that are positioning themselves as enemies of the U.S., like China and Russia, don't want to hold treasuries that are paying just a 2% yield when headline inflation, CPI inflation, is at least 7.9%. It's actually much higher, presumably. So you don't want to be earning 2% on your money while your currency is losing purchasing power at nearly 8%. That's a minus 6% annual return. So the people who run these large countries that have been buying U.S. treasuries, obviously Russia has really scaled back their treasury purchases and have been buying gold instead for the past 5 years, and they actually sold off most of their treasuries. But we have this issue that if the domestic banks can't buy treasuries and traditional foreign buyers of treasuries like China don't want to own it anymore, what is going to happen? Now, these countries like China, as they've seen what's happened to Russia, they certainly don't want to hold treasuries if their money can be frozen. If this sovereign immunity for central banks holding treasuries is no longer good, and this is what we've seen with Russia, where their FX reserves have been confiscated and frozen to the extent that the EU and the US can do that, you don't want to be holding treasuries that have this counterparty risk and that can be frozen if you're an enemy of the US. So this eliminates another whole class of buyers of treasuries, and really China figured this out a few years ago. They've been fairly flat in terms of their buying of treasuries, which means that the Fed has had to step in. If you're finding this video helpful so far, be sure to hit that subscribe and like button. So really the Fed, the Federal Reserve, the U.S. Central Bank, has become and is the buyer of last resort of treasuries. And it's always these marginal buyers that set the price. The price in all markets is set at the margins. And so the Fed stepping away and stopping quantitative easing is very, very significant. The market's has been pricing this in for a few months, and that's why we've seen a huge sell-off in risk assets. When the Fed steps away from the Treasury market as the buyer of last resort, the wheels start to come off the financial system. We've certainly seen this with momentum stocks and growth stocks. This is why we've been on the sidelines really since November or December, especially for Treasury University premium subscribers, it's been a very bad environment for trading momentum stocks. So we've stepped back completely. We can see the ARK ETF here, Cathie Wood's ETF, hitting new lows this week, and really has been going straight down since February of last year. In addition to growth stocks and other speculative stocks and momentum stocks weakening, we've now beginning to see cracks forming in the whole financial system. We're seeing junk bonds selling off. This is the ETF for JNK, and it's been selling off, not quite as bad as what happened in March of 2020, but we're really seeing the beginnings of this market possibly imploding unless the Fed resumes buying. They were actually buying junk bonds during early 2020. So we have growth stocks selling off, momentum stocks selling off, a lot of the high-tech darlings. We have more speculative bonds selling off, and we have now the indices entering into downtrends. We have the QQQs having had a death cross. The S&P 500 is about to start a downtrend with a death cross as well. Perhaps more significantly, we're now seeing liquidity problems in the Treasury market. There have been a few articles this past week on Bloomberg about off-the-run Treasuries trading with less liquidity. This was a problem during March of 2020, and there have been a lot of calls for the Fed to step in and start to provide liquidity to the U.S. Treasury market, to the government bond market. So these cracks are beginning to form, and the real reason they're forming is because the Fed is the buyer of last resort, as we said, of Treasuries, and they are stepping away from the market. There's a lot of talk, will the Fed now be able to shrink their balance sheet and let these Treasuries and mortgage backs just mature and roll off of their balance sheet? This is what we call QT. If quantitative easing is printing money and adding assets to the Fed balance sheet, QT, or quantitative tightening, is stopping printing money and letting the balance sheet actually shrink, the Fed's balance sheet shrink. Well, look at what has happened. The Fed hasn't even started to shrink their balance sheet. They've still been growing it. As of last week, we saw they made that final $4 billion bond purchase. But look what's happened just with the Fed stopping growing their balance sheet. As we said, we've seen growth assets, risk assets, junk bonds, and even Treasuries. We've seen the cracks begin to form. Risk assets selling off sharply, bond yields beginning to rise sharply. What happens when you get falling asset prices, when the price of your stocks or your house falls? And we haven't really seen this happen yet in the real estate market, which has a little bit of a lag to the extent that the stock market sells off. This tends to hurt the real estate market. But if these falling asset prices, whether it's stocks or eventually real estate, will hurt tax receipts, which means that the government's collecting less taxes and will need to borrow even more money as a result to make up the difference. It will need to issue even more debt. And the reason for this, the reason that the U.S. government's going to need to continue to issue debt, is we have this spending problem. This is, we bring in $4 trillion worth of tax revenue. Government spending is currently about $7 trillion. So there's a shortfall of about $3 trillion that needs to be made up by borrowing. So you might ask, why doesn't the U.S. government just spend less money? The reason is because the largest budget items are not really things that can be changed without huge political or social consequences. You have Medicare, Medicaid, you have Social Security, and these payments will continue to increase as the boomers continue to retire. You can't really cut these. People paid into these entitlement programs, and they deserve to get their money back. And in addition to the fact that the boomers are a huge voting bloc, so you're not gonna cut this, and it wouldn't be fair to cut it either. We have defense spending, which is currently at about $800 billion. This is not something you want to cut, especially given what's happening with China and Russia right now, and the sort of emerging great power competition. And you can't default on your debt. You can't stop paying interest on the debt. So this is the fundamental problem with the U.S. government's deficit spending. But if the Fed does not buy Treasuries and help to monetize this deficit spending, then Treasury issuance will begin to crowd out everything else. This will cause interest rates to continue to rise, which will squeeze the real economy, which is a highly levered, highly financialized economy. Meanwhile, what do our political leaders think? I couldn't even believe this this quote from Nancy Pelosi from yesterday. It's important to dispel some of those. This is Pelosi speaking. Some of those who say, well, it's the government spending. No, it isn't. The government spending is doing the exact reverse, reducing the national debt. It is not inflationary. This is how out of touch our leaders are. And I don't mean to pick on the Democrats. This is a problem on both sides. The Republicans under Trump did huge deficit spending as well. So really both parties participate in this. But Pelosi's comments are especially appalling, saying that government spending reduces national debt. Here's the national debt. It's gone straight up. It's not reducing it at all. Obviously, I don't need to tell you that there's a lot of inflation in the system right now. We're hitting inflation numbers that are comparable to where we were in the early 80s. And this is even with a very massaged CPI number. Meanwhile, the Fed share of the Treasury market has been at record highs, as we can see here, over the past 2 years, where the Fed is now controlling nearly 25% of the Treasury market. So it's a very, very big player. And the fact that they've turned off the money printers is having and will have significant effects, not just on risk assets, as we said, but also on the Treasury market and its liquidity as well, because there's simply U.S. government needs to keep issuing treasuries, and there are not enough buyers of them apart from the Fed. I think Harold Malmgren, who's really a consummate Washington insider, he worked for Kennedy and Johnson and Nixon and has a long history in Washington, D.C., he made a very interesting comment. Someone was talking about all the metals, the problems on the various metals exchanges, and how trades have been canceled, etc., and how there wasn't enough collateral kept on the exchanges. Obviously talking about nickel and some of these other metals that have been melting up. And Malmgren's comment was, I think we shall soon be seeing inadequate collateral underlying many other markets besides metals, even including global markets in high quality collateral as leverage rules have gone amok. He's obviously referring here, he doesn't want to say it, but he's referring to government bonds, especially treasuries. And this is really the crisis that we're in the middle of. If Russia and China don't want to buy our treasuries and the U.S. banking system can't hold any more of them, someone needs to step in, and you have these cracks forming in the treasury market if the Fed is not a major player in printing money and buying treasuries. So Malmgren is obviously seeing what's happening here as well. Someone is going to need to buy all of these treasuries, all of these government bonds. You could either change the rules somehow, ignore Basel III, let the banks hold more, find a sneaky way to just temporarily suspend these rules as they did in 2020 and 2021. You could force U.S. pensions and endowments to buy more treasuries. You could sort of regulate them into being forced buyers of these, which they already are to a certain extent. Banks and pensions are forced to hold a certain amount of treasuries. You could increase these ratios theoretically, or what's probably more likely is the Fed is going to do something sneaky to buy bonds and to buy treasuries while not calling it quantitative easing. And we don't know exactly the form that this will take, but they're trying to claw back their credibility while still not letting the entire financial system implode. Meanwhile, things are going to keep blowing up until the Fed reverses course. This is bad for risk assets. It's bad for stocks. It's bad for real estate, and it's bad for Bitcoin as well, to the extent that Bitcoin remains correlated with risk assets. Bitcoin really is the ultimate safe haven asset and flight to safety asset, but the market hasn't figured that out yet. And so to the extent that risk assets continue to sell off, we probably see Bitcoin remain weak, at least until the Fed reverses course. And I think what's really interesting is that even the war in the Ukraine has not driven a flight to safety. So Russia invaded the Ukraine on February 24th of this year. On February 24th, the 10-year Treasury note had a closing yield of about 1.97%. And we're now trading at a higher level than that. We're trading above 2%, which is very, very unusual when you have a global crisis like this. When you have a geopolitical crisis, at least traditionally, you've seen a huge flood of money into treasuries, which drives yields lower, obviously. Instead here, we've seen treasury yields creep higher in spite of these geopolitical tensions. And I think that shows really how important the Fed is here as the marginal buyer of U.S. Treasuries. So expect this sell-off to continue. I would expect things to even get worse until the Fed reverses course. Meanwhile, this is a great buying opportunity to continue to accumulate Bitcoin at really rock bottom prices and to be ready for when the Fed turns the money printers back on. When that happens, we will see new all-time highs in Bitcoin fairly quickly. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.